about 25 years ago, through an asset injection, companies the government used to own, but we turned around, we then listed them, sold them, and the monies that we got, we continued to invest and reinvest. We do direct investing, we do LP investing, and one feature is that we actually don't have ongoing revenues or monies coming into us from, say, oil monies or pension monies or other monies. It's basically, if the investments do good, then we grow. And then in the US, we are doing exactly what we do the world over. Again, direct investing, LP investing. Much more later stage venture focus, of course LP. We're looking into public investing, haven't started that. And then there's a small sliver of early stage VC investing.
I'm Zhang from China Invest Corp. I do have the public equity, but the team, we come with me, will have a venture capital invest team as well. We do have a large portfolio, probably one of the largest the sovereign wealth fund in the world, and we have a very strong interest in investing in the future of this world. And when I mean the future of this world, is we're looking into the technology and how this technology will evolving all humankind, helping or the society solving that's the challenge in the development, we're using different formality in investing in this world or in this trend. We're using other venture capital fund to invest in the early stage and also in the growth stage. And we also, if the deal is sizable, we also love to invest into this deal. And in public market, and we do have a strategy focus on the growth, which is mainly technology and the biotech, which is both Bay Area offer a lot of opportunity, and that gave me the chance to come back to the Bay Area to visit those companies. So we're really looking forward to working with whoever you are, the founder of the company or you are the venture capitalist in investing in this field, or you are the public listed company. We're willing to work with you and help you to grow your business.
My name is Edmond Fong. I at the University of California Office of the CIO. I oversee our absolute return and strategic opportunities. So I'm not a venture capital investor per se. We manage about $105 billion on the behalf of the University of California school system, which is comprised of 10 campuses, 5 medical centers, and 3 national laboratories. We're the 3rd largest employer in the state of California. We have roughly 250,000 students between undergraduate and graduate, as well as 150,000 faculty and staff. And so the pools of capital that we oversee include the general endowment pool, the pension plan, defined contribution program, as well as the working capital pools for the 10 campuses. And we also have a captive insurance vehicle that we also oversee as well.
My name is Alaa, and I'm working with Mubadala to establish their venture arm here in Silicon Valley. For people who don't know Mubadala is a sovereign wealth fund for the government of Abu Dhabi. And we're roughly $120, $130 billion asset under management with sort of a socioeconomic mandate, at least at the inception of Mubadala, that was the core mandate, whereby we own and operate various assets in various sectors, including healthcare, real estate, oil and gas, obviously, as well as aerospace, metals and mining. And specifically under Mubadala, there is Mubadala Capital, which is an alternative investment vehicle for Mubadala. And we invest in hedge, private equity, and credit. And recently we were launching a $600 million fund, in Silicon Valley that is focused on sort of like two strategies. The first strategy is a fund-of-fund strategy where we become LPs in Silicon Valley or North America-based funds, whether they are established or emerging. And the other pool of capital, we use it to invest directly in companies of Series B+. So what we do is we invest in companies that we believe can benefit from the portfolio of assets that Mubadala has to offer. So whether it's a big data analytics company for oil and gas, or a surgical robotics company that we could use the platform of Mubadala outside North America to help springboard their international expansion by having a dedicated business development team that acts as an extension of the business development teams of the portfolio companies. This is where we add significant value, we believe, which is beyond the capital. Also, Mubadala Capital is sort of like the managing arm for a $5 billion fund between the government of Abu Dhabi and the government of China that targets infrastructure plays at both countries, but also private equity and sort of venture capital investing in China as well.
Okay, great. For long-term investor, of course, this is a new subject for today. I'm curious. Earlier, people can only, long-term investors can only invest into public companies or the LP of the venture capitalists. But the last few years, and many late-stage companies, the unicorn, actually receive a large amount of investment. Many of them actually are long-term investors. So between pre-IPO unicorns and the venture capitalists, as well as public sectors, where is your favorite one and why?
That's a tough one. So as an entity, we do all three. So we do public investing, we do some pre-IPO investing, we do late-stage venture investing, different things in different countries. The theory goes, there is a risk spectrum, there is a return spectrum associated with these three types of securities, and then you marry that with what are the skills that you need to do well in these industries. The skills required for VC are very different from the skills required for public equities. The networks you need are different from both. And then each fund has things that they're really good at in particular countries, and so it's sort of a very, very fund-specific question. And then we pick and choose. So in the US we do a little bit more of late-stage venture. Other places we've done both public and actually even private equity. That's further down the spectrum. But maybe one question to ask yourself is, where is there market inefficiency? It's very hard to say that public investing in the US for, say, large cap, well-traded companies, there is much of an edge you have. You really only take exposure to the market. Pre-IPO, maybe, but pre-IPO deals we see generally large, generally very well shopped around, and maybe inflated. There are some risks there. Venture seems like there are inefficiencies. New technologies are coming. Maybe you want to take exposure to it, but it's a two-edged sword. You can make quite a bit of money, and you can lose quite a bit of money, and it all turns out you kind of need to know, have a view on within particular subsectors. What are the skills you need? What are the resources you need? What are the networks you need to be successful there? And do you have it or not? Mentally, that's kind of how I look at it.
Well, I view that the whole spectrum of the investment vehicle and opportunity, and I do evaluate all spectrum, and like Jen said, in a certain sector, you don't find those stocks in public market, and then you go private and see where the opportunity. If this is truly represent the opportunity, truly represent a disruptive force to destroy the existing, then you should go. Think of Airbnb as a unicorn. It's destroyed, not disrupted the hotel hospitality business. That represent a new force of this the changing of this business. You don't have anything listed, right? You don't find it comparable. So if you like it, and then you go with it, right? I think when I look at the VC, it's about the future of the industry. You're betting on the future. That's why I think there's a lot of venturists here. When you bet, it's not that you're betting on 5 times or 10 times. You think about 100 times, or you think about something come in and completely change the world. As an investor, what the purpose of the investment is really you're looking for return. In the capital wise, in the financial wise, you're looking for the return. But meanwhile, if you think about you can change the world, of course it's good. But you're looking at the financial return that eventually a technology will drive the change of the world, and that would be associated with a financial return. And meanwhile, maybe the other, the existing business may be impact. I have a conversation with the friends. I was arguing someone should swatch, because before Apple Watch was launched, because I thought everyone gonna wear Apple Watch instead of your Swiss watch. Eventually I would say maybe 20 years after your kids, when look at your collection of this Swiss watch, you say, what is this garbage? But of course, that's taking time to change. So, I view this venture, unicorn, public is all investment too. You're looking for the opportunity, you evaluate that by its valuation.
I think at an earlier fireside chat, it was said that compounding returns is the most important thing that we should be thinking about as investors. And at the UC, we don't think about filling buckets or chasing exposures or asset allocation in that way. We do think across the spectrum of risk, and we have to consider the spectrum of risk and the returns reflected across different opportunities and evaluate them more from a bottoms-up perspective as opposed to a top-down. And so with that lens, we like to first think about opportunities in particular where we think we can find value or an edge, or find partnerships or relationships that we think can cultivate an edge in one area or the other. So we don't have preferences per se from an asset allocation or asset perspective. Those things change over time. What we're really seeking is just unique opportunities and build relationships to mine those opportunities. Presently, I think as a reflection of the lack of opportunities perhaps, is we've been really long cash for a number of quarters in the endowment, for instance. And actually, to that point, we at the UC, because we have to manage an endowment as well as a pension and working capital, we consider opportunities that are appropriate for each of those pools of capital. So we're always constantly weighing the risk return out there in these things, and we have to then think about the best pool of capital to invest from.
Yeah, I mean, I echo what Sunny specifically said, which is it depends on the risk profile that entity is willing to have. And Mubadala plays in all different aspects of alternative investments. However, personally, I believe the most important for an investor is value creation. And that value creation needs to be mutual. So if you look at Mubadala has those assets. And the venture capitalists have invest in disruptive ideas. And we believe that if our assets don't get access to that innovation, with time they're going to become irrelevant. Right? If they don't have the state-of-the-art kind of artificial intelligence or machine learning capabilities and algorithms for oil and gas, they're just basically going to become irrelevant and uncompetitive. Right? So I think, for me personally, I think venture capital is the most relevant long-term investment vehicle for Mubadala because of this mutual value creation that we can bring to our portfolio companies, but also to our asset base. I mean, granted, maybe the IRRs are kind of different profile, the multiples are much higher, so economically also it makes sense. However, the value creation, I believe, is going to be much higher for both entities at a venture capital play than every IPO or a hedge or a public equity market.
There you mentioned about it's all about price valuation. So let me ask you about unicorns valuation. In the last 2 years, many of unicorns are facing big challenges, but some other ones are still doing pretty well. So do you believe there's a bubble in the unicorns pricing? Do you believe investing in unicorn is the way, is better than doing the venture investment, like A1, B1 investment?
Certainly, there's a, when you look at it, sometimes in private market, it's not that efficient to reflect the valuation, because the valuation is only reflect as a last run of the VC. If the market change or if their business change, the market is not absorbing that information, and at least the information is not reflected on their price. So there's a likelihood that there's mispricing for this unicorn. That's very possible. When we're looking into this, we believe the liquidity, illiquidity, you should pay a premium. Liquidity is a good thing. But this world is sometimes there's distortion that people willing to pay for illiquidity. So you don't observe the price, you feel good about it. But that is you just close your ear. It's not a wise thing. If you can find opportunity buying, have exposure in a similar growth opportunity in public market with a cheaper price, why not, right? And you betting on the unicorn, but if this unicorn is purely have a monopoly or dominate force in this industry and keep growing, and there's a future for that, then you go unicorns fine. That's, I think that it's all based on the opportunity.
Else has comments on this question?
Yeah, of course. I mean, if you look at Airbnb and Uber, the largest taxi company right now doesn't really own taxis, right? Doesn't own cars. The largest hotel company doesn't really own real estate, right? Which is Airbnb and Uber. And those are unicorns that I believe have sustainable differentiation and has done paradigm shift in how we as a society really operate. And with Silicon Valley, you will see that some companies are overhyped and they reach the unicorn business, the unicorn level, even that they don't have the fundamentals of a business. Their unit economics are not really sort of positive. And it really depends, right? I mean, if you're going to chase unicorns, there's a saying, right? You will never see them, which is, you really need to believe that the company has the right business fundamentals and also is doing something that changes the way that the society go day in or out of their life, and also is a sticky business, right? And definitely unicorns are best because they help you reach your financial profile, and everybody as a venture capitalist hope to have in their portfolio a company higher than $1 billion valuation companies, but you shouldn't chase them. You should help create that value with the company and believe in the business fundamentals of that company to be able to invest.
Yeah, I think that's spot on in that price is what you pay, value is what you get at the end of the day. And it's a very case-by-case sort of issue here. It's about idiosyncratic risk. And so it's as interesting as the moniker may be, unicorn, it really doesn't, it's kind of arbitrary in our view. You have to really evaluate it on a case-by-case basis.
Maybe maybe I'll add to that. Academic research shows that, or says that it is tough to predict bubbles. Some folks have come up with indicators for bubbles, but those are across sectors. How quickly is it run up? How extensive is it? Or not. Very tough to apply it to specific companies and say, oh, this is a bubble. Now, take the case of Ubers or Airbnbs and others. There probably are some scenarios where this sort of valuation is justifiable. I mean, people have invested quite a bit of money into their last rounds, and the assumption is those scenarios will get met. Now, if scenarios are relatively simple, that you have to increase revenue by some achievable amount, okay, maybe some of that is predictable. If scenarios become you have to increase revenue and consumer behavior has to change, and a couple other things like the execution needs to be near flawless, near perfect, then the case starts weakening, and so it's hard to say some of these valuations will last.
Great, actually time flies, so I'd like to invite our first speakers to give 20-30 seconds closing regarding the cycle. So I just read the news that CBN said the budget last Q1 overall venture investment was $16 billion. It's a lot better than Q4 last year. So everyone were talking about venture in the last 2 years. Is the spring come? And you suggested just our closing. Anyway.
Sure. I mean, if you look at the landscape right now, there's a lot of foreign capital being. I mean, Mubadala is one of the kind of end users of this additional funding within Silicon Valley specifically, right? So there are a lot of Chinese investors, a lot of Middle Eastern investors, whether you call them tourist investors or not, right? I mean, they are inducing a lot of capital within the ecosystem and accordingly helping, maybe artificially, driving more and more investments. There are still a lot of skepticism around the valuation. A lot of companies that actually raised in 2015 at high valuation are coming to market right now to have another round, right? So you will see that maybe in the next 12 months there will be a lot of companies that are going to potentially raise money at an undervaluation, and accordingly, winter, is always coming. It's seasonal. And that's why it's cyclical industry, but we believe that it's still also kind of the tail end of it, and there are some challenges still in raising capital, especially for the ones that have raised at the peak of the valuation.
Okay, let's give it a shot.
So this, the title of this panel is long-term perspective, and so we tend not to think about the quarter by quarter. I think we're in a unique position as a university to observe that innovation is actually not seasonal. We see that every day because on average we have 5 inventions that percolate from our system on a daily basis. And so whilst we may see some ebb and flow in activity, we are sure that innovation in itself is pretty much a all season, all weather type of activity.
I think there's a lot of dry powder in this world, but the world is always have excess capital, and then the capital is destroyed in some way. But I think that the capital used for the innovation, changing this world, helping evolving the humankind, that's the best way to spend. So I think that this world is changing, and that something will work or changing our life permanently. That will be technology. So I do endorse the technology investing.
Yeah, so if you look at how activity has actually grown, so 2009 to 15, investment activity went up, and it's sort of come down from that. Yes, Q1 this year is higher than Q4 last year, but I think it's lower than Q1 of 2015. So maybe there's a drop. But I don't think we should anchor to the top, nor should we anchor to the bottom. So this is a cyclical business. I think the thing to maybe focus on is that people are getting more sophisticated, investors are getting more sophisticated, and they're diligencing companies more. There certainly is a lot of money. The market isn't clearing, so maybe people are being more diligent about their investments, which in effect is a good thing because money then flows to deserving companies, and so you can create better innovation that way, which is the whole point.
Great, let's give one plus our speaker. Thank you. Last one, actually, I want to invite all of you to give a warm welcome to our keynote speaker tonight, the Chief Information Officer of China Investment Corporation, Mr. Zhang. Welcome.
Good afternoon, ladies and gentlemen. I would like to thank the hosts for the kind invitation. So my speech is covered two parts. The first part about Chinese economic, about the new normal of Chinese economic and innovation-driven development. The second part I'll introduce CIC or China Invest Company's overview investment strategy. So begin the first part. Firstly, investments and exports were the main driving force for China's economic growth during the past 30 years. Over the past 30 years, with the low economic base, economic reform unleashing productivities and population dividends, China enjoying high-speed growth, mainly driven by investments and exports. Infrastructure has been key components of the big success investment. For example, China accelerates urbanization and mass investments in railway and highway construction. By the end of the 2016, total mileage of the railway in operation had reached 124,000 kilometers, including 22,000 kilometers of high-speed railway. China ranks first in the world in the term of the mileage of high-speed railway. Infrastructure development significantly improved efficiency. For example, it just takes only 5 hours to travel 1,200 kilometers by high-speed train from Beijing to Shanghai. Yes, less than 1/3 of time needed for ordinary train. The other major driving force for development was exports. This is the case especially after China entry into WTO. Its export grew rapidly at average annual rate of 15%. More than 15% of the export was processing export 10 years ago, and 35% even then. China export mainly processed and assembled lower-end products, and lower labor cost and Chinese attitudes enabled China to take orders around the world and therefore become a world's factory. The second, China is performing economic restructure on the new normal, and innovation is emerging as a new driving force. In recent years, China's economic growth has been slowing down. Its annual growth rate of GDP decreased from about 9% over the past 30 years to now about 6.5%. An aging population and growing labor costs makes old development models unsustainable. Chinese economy needs new and sustainable driving force who avoid the middle income trap. I think innovation is the most important one among them. The outline of the 13th 5-year plan in next year prioritized the innovation-driven development strategies. During the 2 sessions in March this year, Premier Li Keqiang also mentioned in his report on the work of the government that China will continue to implement the innovation-driven development strategies and push forward economic restructure and transformation of driving force through innovation. Economic restructuring includes the upgrading of consumption. Steady growth of the revenue significantly improves people's consumption capabilities, and their consumption needs shift from basic necessities to high-quality lifestyles, unleashing great potential demand for consumption upgrading. In the future, domestic demand will have more weight in the total demand, and consumption will outshare exports as the driving force for China's economic development. The need for consumption upgrading poses high requirements for manufacturing. Low-end products will be replaced by the middle and high-end ones. Now some low-end products are shift to South Asian countries. This transformation requires both productive design and manufacturing process to be more technology-based. China's manufacturer endeavors to shift from made in China to created in China. Third, entrepreneurial environment and motivation for innovation are being fostered. The government tries to foster a favorable environment for starting up companies from their establishment to IPO, so as to encourage mass entrepreneurship and innovation. To achieve this, the government has established venture capital guiding funds to encourage the development of venture capital, deepening reform and development of China's multi-line capital market, and gave us tax benefits to start-up companies. Over the past 3 years, the makerspace venture capitals and start-up companies have been thriving, according to statistics. During 2014 to 2016, the number of the makerspace surged from more than 15 to about 4,000. And the total number of the angel funds and venture capital were close to 3,000. These funds make $100 billion investments in last year. There has been 131 unicorn companies in China in 2016. Most of them are Internet plus related sectors such as Internet-based financial e-commerce, automobile traffic, and auto. Of course, we all bear pressures of the valuation risk. So the Internet technology are changing China. Nowadays, in Beijing, Shanghai, and other big cities, you can see the colorful shared bicycle on every street. Simply scanning the QR codes, we can unlock the bicycle for people and to ride whenever and wherever they need to. The shows, no matter big or small, accept the payments by WeChat or Alipay. So China cannot need cash on them, also like credit cards. Enterprise in need of the shipping service can use the app of the Truck Alliance, which allocates suitable truck driver nearby. It can cart empty truck and increase efficiency of the shipment. It is fair to say that internet and other technology have deeply engaged in all aspects of the consumption and the manufacture, and played an important role in upgrading traditional industries. We hope there is to be more beneficial cooperation with foreign companies and some venture capitals, so as to consolidate the advantage on industrial chains, jointly develop the markets, and meet Chinese huge demand for consumption upgrading. So I'm more the second part about China investments overseas. The CIC is China's sovereign wealth funds, established in 2007. Now it passed almost 10 years, which amounted to make diversified investments of China's foreign exchange holdings and maximize the returns within acceptable risk tolerance. At present, the size of the CIC investment overseas is more than $200 billion, or long-term capitals. CIC's key investment principles are as follows. The first, CIC investment on the commercial basis. It manages risk and increases return of the total portfolio through diversification. At present, all asset class and strategy in CIC portfolio to cover public markets, stocks, fixed incomes, and alternative assets, like hedge funds, real estate, infrastructure, private equity, and credit. Second, CIC is minority financial investment. It targets seeking control of the company in the portfolio. Now, 2/3 of CIC assets are managed by externally. The rest are in-house investments, including public market portfolio investment strategies, core investments in alternative assets, and direct investment strategies. The third, CIC investments are driven by research and asset allocation. This is ensure independent and prudent decision-making and disciplined investment activities. The fourth, CIC is a responsible investor. It abides by the laws and regulations, both China and the receiving countries and regions. CIC also continually fulfills its corporate social responsibilities. Given its investment principles, the long-term investment horizons, and relatively high risk tolerance, CIC in the future will increase alternative investment, especially direct investment, and steadily raise the weight of alternative investments in the portfolio to 50% in the future, 5 to 10 years. So the infrastructure and high-tech will be the two areas of growth for CIC going forward. Firstly, about infrastructure investments. we see the real demand for infrastructure development will still in the US, European, and emerging markets, including China. President Trump is advancing his $1 trillion infrastructure plan. The Chinese government also initiates the Belt and Road initiatives to pour capital from global so as to join investment in the infrastructure in the world. There's the old Chinese saying, if you want to get rich building road forces, the experience of China's development shows the sound infrastructure not only increase the shipping and the transportation efficiency, also can bridge communication and reduce regional conflicts and poverty by increasing interconnectivity. It creates both economic and social values. In terms of the investment, infrastructure as an asset class can generate steady returns in long term. And it is in line with CIC's long-term approach. CIC will continue to increase investment in infrastructure under sound risk management. Of course, we are interested in going to President Trump's $1 trillion infrastructure plan. The second, about the high-tech investment. Every technology revolution brings productivity, leaping forward, and creating huge investment opportunities. Nowadays, we will see the high technologies, especially internet and semiconductors, are transforming traditional industries, including travel, boats, shipping, and manufacturers. In the future, the development of the new materials, AI, and biotech will have greatly influenced our economic and society, unleashing tremendous investment opportunity. Under the new normal, China consumers have a great demand for consumption upgrading. China has become the biggest market in the world for vehicles and smartphones. China consumers are quickly learning of the new technologies. I think it will reach a win-win result as China demands and high technology companies is well connected. CIC is a key player in China investment overseas. So investment in venture capitals, PE funds, and public markets, by funds, core investment, and directed investment. CIC willing to support high-quality enterprise to make innovations, develop the new technologies, and increase profits, so as to meet ever-growing demand for consumption of Chinese consumer and seeking common benefits for everyone. Thank you.